Thank you, Chair, and thank you, Ewan. I joined as Chief Investment Officer on New Year's Eve last year, so I have been in post for all of this year. I'm a couple of months behind Ewan, but as mentioned, we're both fairly new in our post. In terms of introducing myself, I have about 20 plus years financial services experience across banking, capital markets, pension funds. In terms of what perhaps interested the panel that appointed me was probably the 6 years that I spent at USS, University Superannuation Scheme, which is the largest occupational scheme in the country. And I joined USS just after the global financial crisis and helped rebuild their investment program across public and private markets. So I was very proud to be appointed as CIO of West Yorkshire Pension Fund. You can probably tell from my accent that I am not from West Yorkshire, but I do now live in West Yorkshire and proud to do so in Ilkley. In terms of the topics to cover, I'll introduce why Ewan referred to the CIO role having been created, and I'll touch upon maybe why that took place. I'll cover the strategic asset allocation review that follows the actuarial valuation that Ewan touched upon, which refers to the healthy funding position of the scheme. We'll talk a little bit about investment beliefs, which members clearly feel very strongly about in different areas. We'll talk about market returns, and we'll talk about the fund performance over the short and long term. One of the reasons that the CIO role specifically has been created is to reflect the fact that, as both the Chair and Ewan have said, West Yorkshire Pension Fund is a very large pension scheme in its own right at 18 billion, but on my estimates is by far the largest in-house manager within the 86 pension funds of England and Wales, with many of those pension funds now having moved into pools where their assets are managed by other people. Another reason the CIO role perhaps was created is that even though under Rodney's leadership, the keep it simple philosophy that has created such a healthy position for West Yorkshire Pension Fund has been preserved, the investment universe keeps moving on, and our allocations across certain markets have become quite complicated to manage from an investment standpoint. And lastly, even though we're not regulated in the same way as, for example, a FCA registered investment manager, we're regulated under LGPS regulations, it's certainly Ewan's intent and mine that whilst we don't need to keep up with the Joneses, we want to take the best of modern practices in investment management for the benefit of West Yorkshire Pension Fund. The logo on the left at the bottom just shows that the layering effectively of the LGPS scheme, which I have had to educate myself in as well over the last few months. Ewan referred to the LGPS legally perhaps as one scheme. It is also 86 underlying local authority pension funds, but it is also 8 pools for which the 86 underlying authorities have become part of. West Yorkshire is part of the Northern LGPS, and so when you see Northern LGPS referred to in any context, that refers to ourselves, Greater Manchester and West Yorkshire, and Merseyside, sorry. The valuation cycle for the actuary was sort of cemented in March 2022, but it takes about a year and is finalised in March of this year. So I was lucky enough to come on board with Ewan in readiness for that being completed in Q1 of this year. As the Chair and Ewan have both said, pension promises are not determined by investments. But in terms of actually the purpose of self-financing the program from the investments, the strategic asset allocation is clearly a critical component for the investment office. And I guess in simple terms, the strategic asset allocation aims to answer the question, what are the expected investment returns required to keep contributions stable and to meet those pension promises? These are codified in a neutral SAA benchmark that the investment office advises on and is then approved by the governance structure that was shown earlier. Once that is approved, it is the job of the investment office to implement that SAA. We need to clearly have resources to execute on that benchmark with appropriate discretion. We need resources to incorporate wider investment beliefs and objectives, and we'll come on to that. And we need to do all of this within a risk appetite. At the July Investment Advisory Panel, we came to the panel and proposed a new strategic asset allocation benchmark based on the work of the actuarial valuation and the internal work that we had done. And so I just wanted to highlight in this slide what the outputs were of that. The first point to note is that it is not inevitable that pension funds have a long-term investment horizon. Many will have seen in the press the decline of corporate defined benefit pension schemes with rapidly approaching maturities, with all of their investments now seemingly in bonds or bond-like investments. West Yorkshire Pension Fund's appetite is still very much for the long-term investment horizon, reflecting, of course, what Ewan said earlier in terms of the position of the fund. We also at this stage retain a total return approach for the next 3 years. So again, some pension funds have had to move to actually looking at their investments on an income basis to meet the liquidity requirements in terms of pensions. We are not at that stage yet and can retain a total return in terms of income and capital gains. In terms of what we proposed and what was agreed in the summer, the main thing that we agreed was that there should be a small moderation in the overall benchmark allocation to public and private equity. It is to the great, it is to praise the previous leadership to make the observation that whereas many pension funds have reduced significantly their equity weights over many, many years, West Yorkshire Pension Fund under the previous leadership retained a very consistent positive stance towards equity markets. As with all things, there are times where that needs to be reined in a little bit. And given our healthy funding position and given the state of the investment cycle, we feel it is time to moderate that equity allocation a little bit. The more significant thing within that choice, however, was to significantly reduce the UK listed equity benchmark weight. So to give a sense of that for members, if one looks at global equity markets, the UK, even though it is a very strong leading economy in the world, is only 4% of global equity markets. So if none of us were here and the investment advisory panel had to simply choose a passive investment strategy and chose global equity markets, only 4% of that would be in the UK. Our previous benchmark within the UK was 54% in UK listed markets. And again, it is to the credit of West Yorkshire Pension Fund over many, many years that it has been such a strong supporter of UK equities when others have left. That said, there is a proportionality in terms of doing so, because by having such a large allocation to the UK, we are somewhat more concentrated to the fortunes of the UK economy, something that Philip Hebson will talk about in a little while. So we have made that reduction and equalized the weights between the UK, North America and the rest of developed markets. The other thing that we have done is to expand the allocation, the capital allocation, to opportunities that reflect wider investment beliefs and wider objectives. So there is a blue part there at the bottom, which is alternatives. It's not a word I particularly like, but it is the word of the investment industry. And this will cover lots of things to do with UK opportunities, to do with affordable housing, to do with levelling up, to do with climate transition. We already make significant allocations to it, but because we have done it all across the total fund, we haven't necessarily always had that singular focus on making sure that that's reflected properly within the overall objectives of the fund, and we will be doing that going forward. The last thing that we did is change somewhat the benchmarking of our investment activity. One of the things that I noted when I joined is that parts of the total fund had references to effectively fixed returns in the benchmark. There is nothing in investments almost other than overnight cash rates that can absolutely determine fixed rates of return when it comes to risky assets. And therefore, we felt it was appropriate that for our growing private market allocation, that we benchmark that against public market equivalents to be fair to everyone within the investment team that is working hard to make allocations across the board. Some slightly more, perhaps, dull issues within the strategic asset allocation review, but they are worth briefly mentioning. The evolution of West Yorkshire Pension Fund's cash flow position is one that Ewan has talked about, but Ewan did refer to the fact that there was some potential slight maturing over time. The second part is that the private market allocation, which we have and has grown significantly, is a more illiquid part of our total fund. So we have to manage the total fund with that in mind. The second part to note is something about costs. Ewan referred to the fact that our investment management costs are first in the rank, and it is partly because of the way that West Yorkshire Pension Fund is managed. As I said earlier, West Yorkshire Pension Fund is a directly in-house managed scheme where the costs associated that from an accounting perspective are predominantly the salaries and other costs associated with internal activity. Whereas when you look at the costs, for example, in pools or external funds, all of those costs are embedded in the net asset value of the fund. So to give an example without being quoted on it, our investment management costs on a formal and accounting basis may be 5 basis points, but on a look-through basis may be closer to 50 basis points, which would be very consistent with the sort of basis point fee that the look-through fund, for example, when I worked at USS was. It doesn't mean we have to report on that basis, but it does mean that we should take a greater interest in assessing the value for money from our external managers, the sorts of things that an FCA registered entity, for example, would have to do as a matter of course. The last thing is just on resourcing. We have to balance existing and future investment activity within the funding context. As I say, we don't have trade-offs to make today because we're on a total return basis. But imagine if, for example, the valuation at some point suggested that we really did need to think more about cash flow, income and liquidity. That would clearly mean that we would have to allocate more of our budget and resources to, for example, a fixed income team, which we don't necessarily have to do today. The other point I would just note is that some members will have noted the government consultation on pooling, which is obviously important to government in terms of how does the one LGPS scheme, the 86 underlying local authorities and the 8 pools kind of collaborate and work together for value for money. West Yorkshire Pension Fund has responded to that consultation, and that's in the public domain, as has the Northern LGPS. I encourage members to read that. From our perspective, and certainly from my perspective, I'm very proud to lead an in-house effort. And I can only imagine that whatever happens with pooling, there will be a strong desire from governments of any colour to have world-class, best investment centres of excellence outside London and the Southeast, which is what I'm determined to maintain and grow here in Bradford. Investment beliefs are always part of an investment strategy statement. And here in this slide, I want to sort of put them into two types of investment beliefs. One type of investment belief is one that is determined by the investment culture and the type of organisation that you work in. And in West Yorkshire Pension Fund's case, some of our investment beliefs have not always been written down, but they are implicit and they are useful to reaffirm. West Yorkshire Pension Fund, as I said before, has a long-term investment horizon. It has a strong belief in the long-term equity risk premium and the ability to provide that equity risk to markets. And it has a belief in the value and the confidence in in-house investment management, which others have let go of. The second part, which I know members have certainly been very focused on in recent years, are what I would call sometimes more qualitative in nature, but they're very important to embed within the investment strategy. So, for example, aligning investments with UN Sustainable Development Goals might be something that members are interested in, and certainly employers are. And therefore, West Yorkshire Pension Fund needs to not only know that it is reflecting employers' and members' views, but actually communicate how it is doing so from an investment perspective. Very recently, we had an investment belief session with the investment advisory panel, and three themes came through, which we highlight here on the right. One is investment in climate solutions. One is sustainable cities and communities, and one is economic growth driving decent work. So I just want to spend the next two slides focusing on those. In terms of climate solutions, for those interested in the UN Sustainable Development Goals, those are goals 7 and 13, which refer to affordable and clean energy and to climate action. It's fair to note that from my perspective, having worked both in the private and quasi-public sector previously, West Yorkshire Pension Fund is not always in the vanguard of marketing itself to its members in terms of all of the activities positive that it does across these areas. So I thought it was worth spending a little bit of time just highlighting what those are. The first thing to note is that we have 4% of the total fund in a vehicle called GLIL, which is a cross-pool partnership that contains both the shareholders of the Northern Pool. It also includes LPPI, which is one of the London pools, and also has investment from Nest, which is what members will have heard of as one of the big DC providers. So we have 700 million of our fund committed to GLIL. It is a long-term evergreen open structure investing in core infrastructure and renewables. There are examples, images here in terms of our allocations to solar, to wind, to bioenergy. And both Ewan and I sit on the executive and investment committee, respectively, of GLIL. And, we are a direct investor in renewables through it. Also, as an aside, a very value for money investor in infrastructure. If you imagine some infrastructure funds pay, you have to pay effectively private equity type of fees. We get our direct infrastructure for about 30 basis points through that arrangement. Some members will remember that under the coalition government, the Green Investment Bank was set up. First of its kind, publicly funded enterprise trying to draw in private money into green and renewable projects. That's now become part of Macquarie's Green Investment Group, but we were early investors in that, significant investors in it, and we have 5 offshore wind assets as part of that. The other 2 logos at the bottom are for 2 IPOs that we invested in back in 2013, which were the first 2 renewable infrastructure funds to actually list on the London Stock Exchange market. If I put all of those things, just those things, and I haven't highlighted everything, we're talking over £1 billion across just the examples I've talked about there. There are 3 other sustainable development goals which are captured in the 3 themes that we talked about: decent work and economic growth, industry, innovation and infrastructure, and sustainable cities and communities. We invest a lot in infrastructure and real estate to build resilient infrastructure, as well as social real estate, which encompasses affordable housing, GP surgeries, care homes, and supported social housing. Within the infrastructure elements of that, we have made, either directly or through partners, major investments in rail, in wastewater and digital technology. And as you can see at the bottom, over 175 million has been invested in social, economic and digital infrastructure, enabling economic growth, innovation and more sustainable towns, cities and communities. We can do more and we must do more to support our areas. It's one of the reasons we've created the alternatives bucket within the strategic asset allocation. But we thought it was worth highlighting all of the good work that has been done over many years by the investment team in those areas. We know that one of the areas that members have been most focused on is the question of our fossil fuel investments. There are questions which I hope people don't mind, for the purposes of simplicity, somewhat bringing together, from Barry Cusack, from Char March, from Harriet Wood, and Pew Tom Taylor, that refer specifically to this important question. The first thing to say is, why is West Yorkshire Pension Fund a big investor currently in, for the example, BP and Shell? Is it because West Yorkshire Pension Fund is so keen on having fossil fuel stocks? The answer is more nuanced. We are a very large pension fund, the 3rd largest in the LGPS sector. We have a large allocation to UK equities, and UK equities has a large allocation to the oil and gas sector. When you put those 3 things together, having 3% in, for example, UK fossil fuels, and another 3% in global energy stocks is not actually an outlier from an investment perspective. It is a function of those 3 things. In terms of the negative basis for engagement, which is sometimes what we quote, we do say that we are likely to care more than any investor that we would sell our shares to. I say it's a negative basis for engagement because we can never know that counterfactual, but actually it is evident in the AGM season that has just passed for some of the resolutions that went through for some of the energy stocks, that it's been highlighted that it wasn't a positive experience for those that would like divestment to see such low turnouts in terms of the votes. And one of the reasons given is that a lot of people have effectively given up their shareholdings and have given it to others who simply want those companies to simply run it purely on a profitable basis without any context or concern for the climate. The positive basis for engagement is that we are a direct owner, the largest by my estimate within the sector, and we are also part of LAPF, which is effectively an aggregated engagement entity covering 300 billion of assets, including ours and the Northern Pools. And as part of that, we can influence the direction of travel, not just by our own shareholdings in some of these stocks, but through the engagement that LAPF does on our behalf. We recognise that there is a balance between supporting management initiatives where they are trying their best to move quickly in the direction that we all want to see, and the idea that they are kicking the can down the road, which is clearly members' concern. The message at the bottom is that we will work ever harder this year with our partners to ensure that we prioritize consistent, tough messaging of the need to go faster in this regard. I won't spend any time on this slide, but other than to say that West Yorkshire Pension Fund spends a long time working with a number of other interested parties to speed up the process of climate transition. And so these are just a number of initiatives that we are part of. Some of these initiatives actually relate to pathways and directions of travel that we'd like to see in terms of metrics for some of these companies going forward. These are the market returns for March 22 to March 23. Investors often think in calendar years, so I've had to get my head around thinking of things in these fiscal years. We know that this particular period, the accounting period, started with the Ukraine war. Middle of that year, we had Trussonomics, and during the whole of that year, we had significant concerns about inflation in the UK and elsewhere. The remarkable thing about market returns in this particular period in time is that the assets that are meant to be the diversifiers, are meant to be the defensive things that you put in the top shelf and don't worry about, were the ones that did most badly. So the two positions in UK governments and UK index-linked bonds, those are the markets which suffered the most. And that clearly reflected a concern that interest rates were already going higher at the short end, would need to go higher at the long end, and that the inflation premium that effectively needed to be embedded in interest rates was going to change. As Ewan said earlier, it is quite remarkable that West Yorkshire Pension Fund had a positive return on a total fund basis for that year. And it is not to belittle it by any stretch, to just make the observation as to why that probably was the case. The two things that West Yorkshire Pension Fund was in terms of its positioning, because we're so positive generally about equity markets, we don't have a significant position in bonds, and therefore we weren't as affected by the 15 to 20% decline in index-linked bonds and conventional bonds. And the other part is that as a global investor, we do benefit when sterling is weak from our overseas investments doing well relative to sterling. And where that was implicitly recognised is actually in our UK equities, which, even though we sometimes think of as a UK economy matter, are actually mostly representing multinationals with revenues in dollars. And the UK equity market was one of the few equity markets anywhere in the world that had a positive return during this particular time period. This slide just shows the short and long-term picture. As Ewan noted earlier, the benchmark itself was negative because it has an allocation to bonds within it. We did a bit better than zero because of our underweights to bonds and our global allocation to markets, as well as our strong, much more smooth profile private market investments. The longer term picture is that one should expect the yellow and blue lines here to be fairly closely aligned. And if you see over a 10-year period, or sort of since inception, which goes back to the late 80s in terms of just the way that we have good data on, you can see that the fund return is close to the SAA benchmark. That's what you want it to be, because effectively the investment office is tasked with trying to meet that SAA benchmark, which is the neutral best expectation of what is needed to meet pension promises without requiring any further support from anyone else. Inflation has been mentioned by Ewan and will be mentioned again by Philip shortly. There have been some questions around concerns about near-term inflation, and one can clearly see why those concerns are there. Inflation was 10.1% for the period in question, whereas our returns were 0.6%. I think both the chair and Ewan have made it very clear that as a matter of principle, pension promises are not under threat from investment returns. But in terms of the self-financing aspect, which is important, the longer term picture clearly shows that investment returns have beaten inflation over the medium and longer term. A slight bit of fun is the LGPS rankings. Every one of the 86 local authorities have different strategic asset allocations reflecting different liability profiles, and therefore these are apples and pears and oranges in many respects. That said, there are some similarities in terms of the general nature of each of us in terms of what we do and how we go about it. So, there is effectively a ranking system in terms of being able to look at where does West Yorkshire Pension Fund rank from a performance measure. Members who've been on this call in the past will have noted, as I did when I joined to look at what we did 2 or 3 years ago, that we were actually in the 60th, 70th percentile, because there was one particular year where even though we had done just fine, our allocation, for example, to US technology stocks or global markets meant that we looked like we had sort of underperformed. That's washed itself out a little bit given the strength of the last 2 years that West Yorkshire Pension Fund has had. And as you can see in the percentile ranking, we are back to a very strong position on a 3-year basis and still in a very healthy position on a much longer term basis. That's all I had. I hope I captured some of the questions, Chair, in relation to climate, but obviously can pick up anything else as when needed. Thank you.